Very much, Ian, and thank you all for joining today. I've been teaching every year at Melbourne Law School, I think, for about 8 years now, and I always enjoy the time that I have. Sometimes it's shorter than I would like, but inevitably a chance to meet up with old friends and collaborators. So a special thanks to the law school, the program, and the center for co-hosting this seminar today. Today I'm talking about FinTech, and we think about the past year or so, technological developments in finance and risks raised by technology in the financial sector have been amongst the leading news stories, certainly over the past year. I think for the first time in the past 8 years or so, there have been more stories about FinTech issues than there have been about financial crises issues. And that is a very positive change, in my view. When we're talking about financial technology, when we're talking about FinTech, there tend to be three different strands of developments that are taking place, all more or less at the same time. The first comes from over the past several years, particularly in the wake of the global financial crisis. There has been an explosion in the number of small startups, small firms often started by either people with technology backgrounds or financial sector backgrounds that are looking at new ways of doing things in the financial sector with technology. And certainly over the past couple of years, this has been one of the major and most exciting developments. But at the same time, there's another trend that dates back almost 10 years now, and that is in the context of what is often called digital financial services. This is the element where we are looking at use of technology, particularly in the context of financial inclusion and development in the context of developing countries. And much of this has been focused on mobile technology, mobile payments, and developments such as M-Pesa in Kenya. But there's also a third strand to this area of FinTech, of technology in the financial services sector, and that is a longer-term development, in particular in the international wholesale markets. If we look at this, there are two main strands where we've seen the most significant development. The first is in the context of payment systems, electronic payment systems like SWIFT, systems like CLS, all culminating in today's $5.5 trillion global foreign exchange markets. The other aspect of this has been in the securities markets, really dating back to the launch of NASDAQ as the first electronic exchange, but very much culminating in today's high frequency and algorithmic trading. And this paper, which was part of a project jointly between myself, Janos Barbaras, and Ross Buckley, first one paper that basically looks at the evolution of technology in the financial sector. And at the moment, and I'll be speaking about this as well, we're working on a second, which is really looking at some of the issues of technology in regulation. And I think what is interesting is if we look at the global FinTech environment today, it is really about these three different strands coming together. And I think the key thing that we are seeing that is changing has to do with the question of who is applying technology in the financial sector. In other words, it is not just from the standpoint of traditional financial institutions, though as it happens, traditional financial institutions remain one of the largest spenders on IT globally, spending in the neighborhood of about $200 billion a year on technology. And this is a trend that looks set, if anything, as a result of new competition, to increase. In addition, we are seeing an increasing number of large IT companies involved. Large IT companies involved not only from the standpoint of providing systems, services, and backups to traditional financial institutions, but IT companies looking increasingly to compete directly with financial institutions via technology. And perhaps the highest profile example of this comes from China. In particular, Alibaba, an e-commerce company, which has become one of the most significant players in the Chinese financial services sector. And finally, the new startups. Startups which are either coming from people with tech backgrounds, but just as frequently coming from people with financial services backgrounds. It's interesting. I remember before the 2008 global financial crisis, if you would talk to someone who had just left an investment bank, invariably they had one of two plans. Either they were going to open a hedge fund, or they were going to open a restaurant. Today, if you talk to someone who has left an investment bank, most frequently they're starting a FinTech startup. That has very much replaced moving into fund management. And the ones that are starting FinTech startups often have in mind starting the startup, selling it to a bank in 5 years, and then opening a restaurant. So things haven't changed that much. The other aspect, in addition to the who, is the speed of development. And this poses a very particular challenge from the standpoint of regulation. And I think the example that we see most frequently in this context is the launch by Alibaba of a money market mutual fund called Yuebao that in 10 months went from nothing to almost $100 billion in assets. It is now the world's fourth largest money market mutual fund. That is speed. Another aspect of speed which we have seen in the context of India. India, as a result of a variety of plans coming together, and something that is increasingly called India Stack, has successfully opened electronic accounts for 1 billion people in less than 3 years. That is speed of development. And this combination of new players plus speed is having both a dramatic impact on financial services generally, but also posing very new challenges for regulators. And I think if we look at the evolution of technology in the financial sector, this is actually something that finance and technology have always gone together. And we actually mark the previous age of financial globalization at the end of the 19th century. If we look at that first age of financial globalization, what was it that brought together markets around the world? It was undersea telegraph cables. Cables that made instantaneous communication first between New York and London possible, and as cables were built between markets around the world, increasingly linked markets in this example provided by the quote from Keynes, which highlights very much, I think, the nature of globalization. At the same time, it's interesting to see last week an announcement between Google and Facebook that they are putting in place a new transatlantic cable in order to support the massive amounts of data that are being transferred across jurisdictions. So we can see very much this first stage of financial globalization underpinned by technology as well. And if we look at today's modern payment systems, and even if we're looking at something like M-Pesa, mobile payment-based banking, very frequently those mobile payment systems rest at their base on existing electronic payment systems established by central banks and banking systems. And of course, Fedwire actually dates as a telegraphic money transfer system to 1918. But it's really the period in the aftermath of the Second World War where we see the most important developments being laid. Across the Second World War, early development of computer technology, particularly in the context of code breaking. And we see in the aftermath of the Second World War the increasing commercialization and development of that technology. We can see some early developments. First credit card, 1950. Telex, the predecessor of the fax machine, the predecessor of today's communication systems, 1966. But we actually mark 1967, the advent of the first ATM machine by Barclays, along with the first portable computer, the handheld calculator by Texas Instruments, as the real mark of the digital transformation of financial services. And I think that this quote from Paul Volcker sort of highlights that. Volcker, of course, in this quote is speaking in the aftermath of the global financial crisis, and he has in mind innovations like CDOs and credit default swaps that, in his view, had marginal real value for the financial system. But he is highlighting that the ATM, that for him was the most important development in financial services of the past 20 years. We can see the basis of cross-border payment systems, fax, chips to the late 1960s, SWIFT, the basis of today's $5 trillion a day foreign exchange markets from 1973. And it is, of course, SWIFT and the Bangladesh bank heist that has received some of the most headlines over the past couple of months. And of course, in some ways, the Bangladesh bank heist brings together all of those different pieces. You have a group of hackers from, we're not entirely sure where at this point, hacking into the computer systems of the Central Bank of Bangladesh, getting access to the SWIFT payment system via the Bangladesh Central Bank, directing payments to be made from the Bangladesh's central bank's accounts at the Federal Reserve Bank of New York to a large number of branches of different banks in the Philippines where couriers are waiting to extract the cash and spirit it out of the country. It's a perfect movie if you think about it. You couldn't come up with a better theme, but very much this is highlighting vulnerabilities in the context of global payment systems. SWIFT links 11,000 banks around the world via desktop access to an international payment system. And this is foundational to financial globalization as we know it. If we look at NASDAQ, and of course, NASDAQ, as I mentioned, is the basis of today's high-frequency algorithmic trading, the stories of Flash Boys. And this is something that, if we think about it, dating back to 1987, 1987, almost 30 years after the 1987 market crash, our best explanation still of what happened is program trading. What is program trading? Program trading is computerized buy and sell orders that executed themselves automatically at preset price levels. That indicates that by 1987, certainly in the wholesale securities markets, computerized trading already played a dominant role. Of course, we see similar things today. Most recently, a flash crash in China's futures markets yesterday. Previous flash crashes in the United States and in other markets. If we look at global securities trading today, the vast majority of trading does not take place between human beings. It takes place between computers. Questions of fairness about setting hedge fund or trading servers next to the exchange server in order to get time advantages. If you spend some time today talking to a hedge fund manager, the hedge fund manager's life in some ways increasingly resembles something out of The Matrix or The Terminator. In other words, the hedge fund manager knows that he or she is not trading with human beings, that any time he or she undertakes any action in the markets, that action will be immediately probed by a large number of different computerized systems. If we look at some of the most recent statistics, in the United States, something like 90% of buy and sell orders are canceled before they're executed. These are simply computerized programs that are directing, trying to search out price directions. So, I think that is an interesting angle. And if we think of startups, we often think of FinTech startups as a new trend. And certainly in terms of numbers, it is. But in many ways, one can actually think of Bloomberg as one of the world's first FinTech startups. What was Bloomberg's background? He was in IT in Salomon Brothers. He was setting up computerized systems to support Salomon Brothers' trading and risk management activities. He took those ideas, established a startup firm with investment from Salomon Brothers, looking much like many of today's accelerators set up by financial institutions. And certainly by the mid-1980s, we see Bloomberg terminals as a normal fixture on financial institution trading desks around the world. And of course, one cannot ignore that if you look at the LIBOR or Forex scandals, much of the activity in the context of market collusion was taking place where? In Bloomberg's secure communications chat rooms. The mobile phone, of course, comes out in the 1980s, and this is not only the basis of digital financial services, mobile payments in developing countries, but eventually of the smartphone. And it's somewhat amazing to think that next year, 2017, will only be the 10th anniversary of the iPhone. And in that less than 10 years, the smartphone in particular has had an absolutely transformative impact on the way that we do almost everything, including financial services. Online banking dates to the early 1980s. By 2001, 8 banks in the United States each have over 1 million online banking customers. And of course, if we think about technology in the context of risk management, the 1990s were really the heyday of value at risk models. This was the period when investment banks began hiring very aggressively physics and computer science graduates in order to develop highly sophisticated risk management techniques. We suggest that in many ways, the 2008 financial crisis was a break. That the 2008 crisis has transformed this aspect of the who and the speed. First, from the standpoint of post-crisis regulatory reforms. Post-crisis regulatory reforms have come at this from a number of different angles. The first is that each time a financial institution is faced with a new regulatory requirement, one of the first things that financial institution will do is develop an IT system to implement those requirements. So direct drive. Second, we have seen financial institutions as a result of post-crisis regulatory reforms exiting a wide range of different lines of business. And this has led, in addition to exiting lines of business, there's also been a continual process of downsizing and job losses. And in many cases, this has driven former investment and other financial sector staff to look for new opportunities, often by creating startups in areas which their former employers have decided to exit. Financing gaps, the fact that we have had problems in particular in most countries with financing for small and medium-sized enterprises, as well as issues not only in developing countries, but also in developed countries of financial inclusion and access to financial services, where we have had an increasing number of startups stepping into. And of course, one cannot ignore the fact of technology. If we think of evolution, we can think of financial institutions, major spenders, and in fact, if we look at the startup scene today, it is in fact the most frequent result for a successful FinTech startup to be acquired by a major financial institution. The numbers of FinTech startups that become large successful businesses standalone, like Bloomberg, is, as with any other industry, relatively small. But this is having a major transformative effect in a good way on traditional financial services firms. After all, if we think of banks, insurance companies, they have traditionally spent a lot of money on research, but this is research to support sales. This is not research and development about better provision of financial services. And the competition from both IT firms as well as startups is driving traditional financial services firms to look at their operations in an entirely different way. IT companies. In some ways, if we think of IT companies, the ultimate objective is to achieve with financial services what Apple did to the music industry. In other words, the view is that if we're thinking about financial services today, financial services is primarily management, transmission, analysis of data. And in many ways, it may well be the case that IT firms are actually better suited to this sort of business than financial services firms. And certainly if we look at the example of Alibaba in China, Alibaba has definitely had this sort of impact on the Chinese financial services system. And finally, startups. Startups are a new area of competition that is impacting on both banks and IT companies. And if we look at startups, it's important to realize that startups are not just focusing on things like customer interface or mobile payments, that many startups are looking at things like secure communications, cross-border payments security settlement, quantitative risk management, algorithmic trading. So when we're thinking about startups, startups are involved in technology in all aspects of the financial services sector, not just things like alternative financing, P2P, and crowdfunding. So if we look at technology in the financial services sector today, you can see a number of different trends. And I think the key message is that this FinTech transformation process is impacting all areas of the financial sector. If we look at finance and investment, it is not just the advent of alternative financing mechanisms. It's not even just digitalization of financing, things like high frequency and algorithmic trading, but going beyond that, one of the most interesting developments is in the context of robo-advisory business. After all, if we think of some of the potential of technology, it is actually to better serve those that may not be served at all today. And if we think of the traditional financial services industry, for big firms, it is increasingly the case that in order to justify the costs of a human being, the amount of assets available to the investor have to be quite substantial. Many firms are now putting a minimum of $1 million to $2 million in investable assets to actually access a human being in terms of financial advice. At the same time, and this of course has issues for universities, but if we think of what outside of that range is available in terms of human financial advice, it may well be the case that a computerized asset allocation system recommending the lowest cost products to deliver the best balance in terms of allocation is actually going to be more beneficial to most people than the advice that they might receive from a human financial services advisor. And at the same time, when we are talking about investment amounts that are relatively small, a few dollars, the costs involved mean that technology is in many ways the only approach. It's interesting to see in this context that amongst Goldman Sachs's most recent purchases, an online bank to access deposits all over the United States, and a robo-advisory firm. The view being, from the standpoint of Goldman Sachs, that they should be able to use fewer people to access far larger amounts of money via technology. And that raises a range of interesting questions. Operations and risk management. Not only are financial institutions already huge spenders in the context of IT, but as a result of competition, we are seeing increased spending from financial institutions. And this is an area, if we look at Asia-Pacific financial institutions have traditionally spent far less on IT than financial institutions from the United States and Europe, which means that even in the context of traditional financial services better using IT to manage their own operations and risks, there are massive opportunities in this region. Payments and infrastructure, I've mentioned already, electronic payment systems such as SWIFT. But of course, the new developments we're seeing things such as the investigation by SWIFT of the use of blockchain technology for payments. We're seeing from ASX here in Australia, from NASDAQ, OMX, investigations about using blockchain in the context of custody, settlement, clearing of securities. So very much, if you think about it a little bit, from the standpoint of things such as OTC derivative settlement, things like blockchain actually are an approach that, had it been available and widely understood amongst regulators 8 years ago, may have provided a much better solution than the solutions which have in fact been adopted. Data security and monetization. I think there are two sides of this, and of course many of us are familiar that a large number of FinTechs are based upon analysis of data, in particular looking for new ways of determining creditworthiness or pricing financial services to consumers. Large numbers of FinTechs that have come up with some sort of correlation between likelihood of repayment and therefore ability to borrow. Now, one of the questions about this is how many of these will perform in the context of a downturn. And that is very much an open question. But at the same time, this idea of data in place. If we look at Alibaba in China, Alibaba thinks of itself primarily as a data company. It is collecting massive volumes of data on everything. It is then using that data, analyzing patterns to be able to make judgments, from things like restaurant and hotel reservation queues, to things like trade financing, to things like investments. That is using data in a different way than traditional financial services firms have. And this is one of the core changes taking place in the post-crisis environment. At the same time, traditional financial institutions have massive amounts of data built up over long periods of time. But traditionally, they're actually very poor at using it. And that is something that we're seeing an increasing number of startups working on, is mechanisms to analyze and monetize not just other data, but data by financial institutions themselves. But of course, all of this raises increasing security concerns. And the Bangladesh bank heist is only the most high-profile recent example of that. Certainly in the United States, financial services is now viewed as a national security issue. That means that certainly from the standpoint of those of you involved in compliance, you've seen over the past year and a half an ever-increasing volume of new rules and regulations dealing with effectively cybersecurity in financial services. And this, of course, if we think about the financial sector, this is one of the biggest risks going forward. After all, financial services today is almost entirely a digital industry. Think about it, often the only time for most of us at which point finance ceases to be digital and becomes a physical transaction is when we pull cash out of the ATM machine. Prior to that, every aspect has been digitized. In some ways, it's good news that large financial institutions' IT systems are such a mess. Why are they such a mess? Because very often large financial institutions grew by way of acquisition. Each time you acquired another firm, you simply bolted on the IT systems of that firm. What that means is that for most large financial institutions today, not only do they not have integrated systems, in fact, they very often have conflicting systems that cannot communicate with one another. That means that it's impossible to access and analyze the vast amounts of data that they might have. But it also means that from the standpoint of cybersecurity, because they have so many different incommunicable systems internally, that they are less vulnerable to disruption. But as they integrate systems, which is for many major financial institutions a headline objective over the next couple of years, that will change. And certainly, as we've seen with the Bangladesh SWIFT example, even systems like SWIFT, which we've come to rely on every day, even institutions like central banks, like the Federal Reserve Bank of New York, are not only increasingly subjected to attacks, but are increasingly vulnerable to disruption from those. And finally, the customer interface, the interaction between the smartphone and other devices with the consumer. And we would suggest that all of these together raise issues that suggest that not only do regulators have to gain a better understanding of these technological evolutionary trends in the financial sector, but that in fact regulators need to be using technology far better in their own operations. We can look at the context of China in particular as an interesting example. And what we're seeing is that in the context of developing countries with high smartphone penetration rates and a generally inefficient existing financial system, that there is potential for quite high levels of disruption as a result of technological developments. This sorts of challenges and disruptions are more difficult in the context of developed countries which already have relatively effective financial systems. But China in particular provides a good example of IT firms outflanking traditional financial services firms because of the existing inefficiencies and problems in those traditional firms, and in many ways becoming more important from the standpoint of the day-to-day lives of the largest number of people than traditional banks. Regulation. If we think about regulation, I've illustrated this previously, but one of the biggest challenges for regulators, this combination of new entrants and speed of development. The fact that something can go from what we call too small to care to too big to fail in record time. Certainly, one can think of the example of Kenya, that M-Pesa, the mobile phone-based payment system, now deals with something like 60% of payments in the Kenyan economy. That means that that has become a core infrastructure underlying the economy. And it's interesting, Gates Foundation last year did an analysis of a number of these mobile-based payment systems in developing countries, and in fact found that some of them have quite good security, including M-Pesa, but some of them actually have very poor security, which actually means that the level of risk inherent in the development of these alternatives may be just as high as the benefits that are being achieved. This context of who and speed is one, a challenge for regulators, particularly in large countries. China provides an example whereby we can see that something can develop very rapidly to a very significant size before regulators even become aware of it. And certainly, this is one reason why China has more peer-to-peer lending platforms, over 2,000, than the rest of the world combined. It's also one of the reasons why amongst these alternative financing vehicles in China, we've also seen some of the worst examples of fraud. A firm that failed in beginning of this year had gone in a period of 18 months from nothing to 900,000 customers. At the time it failed, the losses were approximately $5 billion US. What was the structure? A classic Ponzi scheme. In other words, money being taken from new customers and used to pay interest and returns to existing customers. How had they grown so rapidly? Well, in fact, they had advertised on China State Television. It's actually open to anybody, but by advertising on CCTV, the implication was that the firm was somehow tied to the state and therefore safer. And this is the sort of concern not only from the standpoint of regulators, but also from the standpoint of participants in the industry. Initially, and the Bitcoin example comes to mind, like Uber and like a number of other examples, initial entrants often had in mind disrupting existing patterns, often developed to avoid regulatory systems. But we're increasingly finding that startups in particular would like to have licensing and registration. Two reasons for that. One, it provides some evidence that this is a valid business, which is actually good from the standpoint of the startup. Second, if we think of one of the greatest risks to new startup firms, it is a major fraud. In other words, if we were to see in a major market a major case of a startup evolving into large losses amongst large numbers of customers, that could fundamentally impact on trust and confidence in the ability of startups to effectively manage risks going forward and kill the industry before it really has the chance to transform. If we look at RegTech, RegTech is about both dealing with regulation through technology, as well as, in particular, regulators using technology. Let me give you a couple of sides of this. I've mentioned the fact that in the context of traditional financial services firms, regulatory changes will invariably drive development of IT systems. But let's think about in the context of the aftermath of the global financial crisis. Large numbers of new reporting obligations. Probably the biggest reporting obligation faced by any financial firm, whether or not it's established or a startup, is issues relating to know your customer. In particular, money laundering and terrorist financing questions. Now, we certainly have reports in the context of Europe of warehouses full of paper reports of suspicious transactions to regulators. Regulators are buried in reports from financial institutions, and much of that reporting ends up being used only after the fact. Something happens and then you go dig through all of the reports to try to figure out what happened and who to pursue. But from the standpoint of the regulatory system, it would be far better if you had a system which would analyze patterns as they developed in order to be able to highlight problems before they emerge. Likewise, from the standpoint of startups, this is one of the biggest cost problems. How do you deal with customer acquisition? And in many jurisdictions, at some point the customer is still going to have to physically turn up, show their physical ID, and sign some physical forms. That is something that not only is ineffective from the standpoint of the regulatory system, but it is a major barrier to the development of new entrants, new approaches to this. And we see an interesting example of the use of technology to deal with some of these issues in the context of India. I mentioned the opening of over 1 billion accounts. You combine that with biometric IDs and the fact that once your ID has been matched to your account, that provides the essential mechanism to support know your customer by other financial firms. That then not only makes the process of customer acquisition easier for traditional firms, but it also opens it up to new entrants. And that is one way in which we can see governments and regulators seeking to support mechanisms which will not impede the market, but actually make things work better. Another example, think about regulators' use of data. This is not something new. If we think to the United States, at least since the late 1980s, the largest percentage of insider dealing cases in the United States have not come from tips or reports. They've come from analysis of stock exchange trading records. In other words, if a merger is announced on this date at this time, all you have to do is analyze the previous couple of months of trading activity to see if there were any unusual spikes in purchases or sales of those shares. And that is how most insider dealing convictions in the United States are actually achieved. Now, of course, in the context of high-frequency trading, one of the biggest challenges for the SEC today is that most trading doesn't take place on the exchange. And so we actually have an ongoing initiative where the SEC is now requiring not only reporting of all trading information on the exchange, but also all trading off the exchange. So that then you will be able to see in the same way for a dark pool or an ECN if there was a spike in unusual activity before a material event took place. And that highlights that in the context of regulation, there is massive opportunity, particularly for regulators in developing countries, to use technology to enhance their own regulation, to support market development, and also to enhance financial stability. If we think of this region, one of the biggest challenges is that this region, unlike the US or Europe, is highly fragmented. This means that it is a real challenge to develop technology which is usable across multiple jurisdictions. And after all, when we think of some of the ideas of democratization of finance, many of those ideas are based on the idea that an electronic system should be able to access customers anywhere and everywhere at all times. But the fact is that regulatory barriers make that impossible, not only in this region, but actually in most regions of the world. Europe, we at least have discussions. The United States, federal legislation in the context of the Jobs Act and others seeking approaches to deal with it, but it is very much a problem in this region, particularly for small jurisdictions. In other words, in a big jurisdiction like China or India, investment in spending yields access to a potentially very large market. But if you are in a smaller jurisdiction with less than 20 or 30 million people, the amount of scale that you can achieve is going to be much less. You would very much like to be able to access other markets, and that is largely impossible at this point in time. Collaboration or disruption. This is something that we're seeing an increasing number of surveys. And it's interesting, if we look back 2 years ago, surveys of executives at major financial institutions a couple of years ago wouldn't have seen FinTech as a significant trend. But if you look at the last year or so, only a very small percent sees FinTech as not significant. The vast majority sees FinTech as either potential for disruption or at least a very important trend in the financial services sector. One bit of good and bad news for traditional financial services firms. That is that in global surveys, despite the global financial crisis, in most countries, people tend to have a higher level of trust for traditional financial services firms when it comes to dealing with their money. But if you break down those surveys and you look at the under 30 age group, you'll find that the under 30 age group very frequently has a higher level of trust for IT firms in dealing with financial services than for traditional financial institutions. And that highlights both opportunities and challenges, as well as, I think, the underlying idea of technological change, which always has been a long-term trend in the financial sector, but the speed of change and the parties involved are the biggest differences today and amongst the biggest challengers for regulators. Thank you very much.